Welcome back to Investing Talk Podcast.
Today, we're looking at Wendy's.
As usual, before we start, subscribe, like, and comment to this video to support the show.
It really does help the algorithm find us, and we appreciate every single one of you.
So it is Friday, February 13th, 2026.
A very interesting day, and we are sitting right on the precipice of the Q4 and full-year earnings report for Wendy's.
Yeah, it's dropping before the bell today.
And the context here is, let's just say it's dramatic.
Oh, dramatic is putting it mildly. We're not just nitpicking a penny on EPS here.
No, not at all.
We're looking at a stock that has been absolutely taken to the woodshed. It's trading at, what, $7.27?
A new 12-month low.
It's actually worse than that. It's a near 6-year low. If you've held this for the last year, you're down about 46%.
Oof. That is brutal.
It's the kind of drop that makes you just want to delete your brokerage app.
It is. It's painful, no doubt. But that really brings us to the big so what of today's deep dive.
Yeah.
When you see a household brand like Wendy's drop almost 50%, you have to ask, is the business broken or is the stock just broken? Because despite all that red on the chart, there's a massive setup here. You've got a PE ratio sitting at 7.73.
Which is incredibly low.
A dividend yield that's over 6% now, and a history of beating analyst estimates. So the real question is this a value trap? Or is this the buy of the decade?
That is the question. And to answer it, we have to strip out the emotion.
You have to.
And just look at the cold, hard numbers. So let's unpack the fundamentals first.
Okay, where do we start?
Let's scrutinize Q3 2025. The revenue picture. It wasn't exactly inspiring.
No, it wasn't.
They brought in $549.5 million.
Which was actually down 3% year over year.
And on the surface, shrinking revenue, especially in an inflationary environment, that's a huge red flag.
Yeah.
It means people aren't buying.
Right. It is, and I don't want to sugarcoat that. When the top line shrinks, the pie is getting smaller, but context is everything.
Right.
You have to look at the beat. Yes, revenue was down, but Wall Street expected it to be even worse. They beat expectations by over 3%.
So bad, but not as bad as feared.
Exactly. But the real story, the one that matters for the bulls, is the bottom line. Earnings per share.
EPS, yeah.
It came in at 24 cents. The estimates were sitting at just 20 cents.
Wow. Okay, so that's a 20%
A
beat.
20% beat. That's huge.
That is a significant margin. But I have to play devil's advocate here.
Go for it.
If revenue is down, but earnings are way up, doesn't that just mean aggressive cost cutting? I mean, you can't shrink your way to greatness forever.
That's a fair point, and usually I'd agree. But this looks like a pattern of operational discipline, not just, emergency cuts.
You think so?
Look at Q2. They beat by 16%. 29 cents versus a 25-cent estimate. It tells us management is incredibly good at squeezing efficiency out of this environment.
So managing labor, reducing food waste, that kind of thing.
All of it. They're protecting their margins. And in the fast food game, that is everything.
Okay, but squeezing efficiency is great for the past. Let's look at the forecast for today.
Right, the Q4 outlook. This is what has everyone so nervous.
The consensus sees revenue dipping even further, down somewhere between, 4.8 and 6.5%.
Yeah, landing in a range of about 536 to 547 million.
And earnings are expected to drop 36% year over year to maybe 16 cents.
It's a steep decline.
If they miss that, given how fragile the stock is, we could see a massive sell-off.
It looks ugly on paper, I agree. The bar is set very, very low. But I want to introduce a signal here.
Okay.
It's the earnings ESP, the expected surprise prediction.
All right, break that down for us. What is that and why should we care?
So think of it as a whisper number detector. The consensus estimate is an average, right?
Yeah.
Some of those analyst numbers could be months old. The ESP looks specifically at the most recent analyst revisions. And when it's positive, it means the analysts paying the closest attention are nudging their numbers up right before the report.
And for Wendy's, that number is?
It's sitting at positive 13.93%.
Wow. That's a strong signal.
It's quite high. It suggests the smart money is seeing data that points to a surprise beat.
So the crowd is selling, but the experts are whispering that the data looks better.
Yeah.
Interesting.
Very.
But we have to talk about financial health, because a cheap stock with a messy balance sheet can stay cheap forever.
True.
I'm looking at the liquidity ratios, and they make me a little nervous. Current ratio is 0.81, quick ratio is 0.80.
So under 1.0.
Right, which means current liabilities are more than current assets. That's risky.
It is technically risky, yes. And if this were a tech company, I'd be running for the hills.
Yeah.
But you have to remember the business model. Wendy's is franchise heavy. They don't own most of the restaurants.
So they're basically a landlord and a brand manager.
Exactly. They collect royalties. That allows for higher leverage because the cash flow is so predictable and steady.
Okay, that makes sense.
And that brings me to the valuation. The market cap is $1.38 billion. A PE of 7.73 just screams undervalued.
It really does.
And the free cash flow is supporting that massive 6+% dividend and the buybacks. They have the cash.
Which means they can reinvest. What's the competitive moat here, though? Is Square Burgers really enough in 2026?
It's more than that. It's the positioning. Fresh, never frozen beef is a huge supply chain differentiator. It's really hard to copy.
And right now, their big play is that $1 Dave's single promotion.
A $1 premium burger in this economy.
That has to be a loss leader. They must be losing money on every single one.
Oh, for sure, they're losing margin on that item. But it's a battle for traffic. It creates switching costs. You get a customer in the door, you steal that visit from McDonald's, and then they buy the high-margin soda and fries.
It's a defensive move.
A necessary one.
All right. Fundamentally, it's a mixed bag. Cheap stock, high dividend, but shrinking revenue and high debt.
A push and pull.
Let's pivot to the charts. Let's see what the price action is telling us.
Let's do it.
And if I paint the picture here, it's undeniably bearish.
No argument there.
It's trading way below the 50-day moving average, which is up at 823. Even further below the 200-day at 898.
It's the definition of a downtrend.
Feels like trying to catch a falling knife.
It does. But we have to look at historical levels. We're at 727. You know the last time we saw prices this low?
When?
March 2020, the COVID crash.
Wow. That is a heavy psychological marker. That was when the world shut down.
Exactly. And that's why it's so significant. When a stock revisits a low from a global crisis like that, it often implies capitulation.
Meaning everyone who was going to panic has already panicked and sold.
All the weak hands are out. Technically, it often triggers a reversal, an oversold bounce.
It certainly feels stretched. We saw that recent 8% single-day drop. The volatility is still there.
It is, but look at the smart money speculative flow. This is where it gets fascinating.
Okay, what do you see?
We saw a specific sweep of options activity. Friday, $8 calls. Over 2,800 contracts bought at about 10 cents each.
Okay, analyze that for us. What does an option sweep like that actually mean?
Simply put, a large, sophisticated trader came in and aggressively bought the right to buy Wendy's stock at $8 very soon.
So they're not betting on a crash.
No, they're betting on a snapback. They're putting real money on the line that this stock jumps back above $8 right around this earnings report.
That is a strong contrarian signal.
It's basically someone saying, I think the market has this wrong.
But if we check the broader market pulse,
Yeah.
the general sentiment does not share that optimism.
No, it does not. If you look at the headlines, it's a ghost town.
Right. The mood is neutral to bearish. I'm looking at analyst ratings.
Hmm.
No recent upgrades in 2025. Just radio silence.
And it's worse than silence in some cases. Citigroup maintained a neutral rating, but actually lowered their price target.
From 9 to 8, right.
Yeah, on February 3rd, right before earnings. That sets a gloomy tone.
And the news stories reflect that. It's all headlines about earnings decline and neutral ratings. It feels like the market has just written Wendy's off as dead money.
But, and this is the crux of the whole thing, that's where the opportunity is.
Explain.
You have this contradiction. You have neutral north analysts cutting targets. And then you have that positive 13.93% earnings ESP.
The sentiment is low, but the data suggests a surprise.
Exactly. When sentiment is this washed out, it doesn't take much good news to send the stock flying. If they just report okay numbers, it could rally because everyone was braced for disaster.
That's the classic value setup. Low expectations are easier to beat. But I have to point out the institutional flow, or the lack of it. No recent Form 4 cluster buying. No insiders are stepping up to buy shares. So if it's such a steal, why aren't the hedge funds loading up?
I think it suggests they're waiting for the bottom to be confirmed.
They want to see the report first.
Right. They'd rather buy at $7.50 on the way up than at $7 on the way down. They want confirmation the bleeding has stopped.
Which makes sense. They want to see if the risks are real. And that's a perfect segue. Let's talk about the bear case.
Absolutely. We have to look at what could go wrong.
The biggest hurdle is U.S. traffic weakness. The estimates suggest a nearly 5% drop in same-store sales.
And in the restaurant business, traffic is oxygen.
If people aren't coming through the door or the drive-thru, you have a serious problem.
And when you combine that with the margin squeeze, it gets dangerous. Beef inflation is real, labor inflation is sticky.
You can't just keep raising prices if fewer people are showing up.
You hit a wall. If they miss on traffic today, the market will punish them, regardless of an EPS beat.
Which leads right into risk number 2. Competition. The value war.
McDonald's is winning on value.
And if consumers are strained, they might trade away from Wendy's more premium positioning.
That's the threat. Wendy's has always been a cut above fast food, but in a tight economy, premium can just mean expensive. So they get squeezed in the middle.
Exactly. The market is pricing that in. That's why the stock is at a 6-year low.
And finally, risk number 3, the debt. We touched on it, but that 26.89 debt to equity.
It's a heavy anchor in a high-rate environment.
And if cash flow dips, that beautiful 6% dividend could suddenly look very expensive to maintain.
And that is the nightmare scenario.
Right.
If they cut the dividend, the income investors are gone overnight. The stock would crater.
So we have the setup. Battered stock, skeptical market, hidden bullish signals, and a valuation that's hard to ignore. It's time for the verdict.
It is time to make a call.
Based on everything we've looked at, what is the bullish score?
I'm giving this a 7 out of 10.
A 7. Wow. That is surprisingly high given the chart. Walk me through the thesis one more time.
Okay, here's the elevator pitch. 1. Extreme undervaluation. PE of 7.73 at 6-year lows. You're buying a legacy brand at a fire sale price.
2. A management team with a history of massive EPS beats. They know how to navigate a storm. 3. That positive earnings ESP, signaling a surprise, is likely coming today.
And 4.
And 4. The 6+% dividend yield. You are literally getting paid to wait for the market to wake up to the value here.
It's a classic contrarian play. Buy when there's blood in the streets. What's the timeline? How do you trade this?
This is a swing trade into and post earnings. The target is that $8 level. That matches the options flow and the city target.
A quick 10% upside.
A quick 10%. But if the 2026 guidance today is good, this extends to a multi-quarter hold. You just collect the dividend and ride the recovery back toward fair value.
So the verdict is, the market has overreacted. The stock's in the freezer right now, but it's about to thaw out. A risky trade, but the risk-reward is skewed to the upside.
Exactly. Be brave, but be disciplined. Watch that 720 level. If it holds, we climb. If it breaks, the thesis is invalid.
Well, there you have it. A deep dive into Wendy's right before the bell. We will be watching the ticker very closely today.
It is going to be an interesting morning.
Don't forget to subscribe, like, and comment. Let us know if you're buying the dip or staying away from the fast food wars. We'll see you next time.
Happy investing, everyone.